All right, guys. Bitcoin is on the verge of total and complete annihilation. We saw the blow up of FTX. We're seeing the blow up of, we already saw the blow up of Celsius. We already saw the blow up of BlockFi. We're seeing the blow up of Genesis. Everybody's blowing up. Everything's blowing up. Bitcoin's going to zero. You should sell everything you have now, and you should do it quickly because you don't have much time. Now, probably not the best impersonation, but that's how I feel that, every other YouTube channel right now is kind of covering, the current state of the market. And, really, I don't think it helps anybody to, share a bearish take right now because, as we all know, Bitcoin operates on a 4-year cycle. And every 4 years, it exponentially increases in price. So am I doing people a service by giving them the bearish take when prices already declined a significant amount from the top? When we say decline, we're talking like a 80% decline from peak to the absolute low. I don't think so, really. We can just do this right here. Basically, you've got your peak right here, all the way down to the low, 77%. Now, if we go in the context of the macro, am I doing anybody a service by telling them to get bearish after a 70% retracement? Let's see, what is typically common. Here you had 84. When the prior bear market, you had 86. So you had 86, 84%, 77%. Now, what people are focused on right now is the concept that, you know, price could go lower, and it certainly can. I mean, you had a deeper retracement in the previous bear market. You had an 84% retracement. So it's not like an 84% retracement can't happen. But I guess what I'm trying to demonstrate is that if, fear causes us to narrow in on the things we're afraid of, and if we're afraid, if we're focused, narrow our focus onto that, a deeper retracement, then we're focusing on an element that draws us away from like the overall risk reward paradigm that exists on the macro, right? If Bitcoin, this is all operating under the assumption that Bitcoin continues its characteristic behavior of, a 4-year cycle and increasing parabolically every cycle. Well, if that's the case, then, we can expect Bitcoin to rally, pretty dramatically, um, up towards the roughly $700,000 region. I mean, that would be characteristic of a bull run in Bitcoin. So, if you're focusing on the fact that it could go lower, you're missing the the greater risk reward paradigm, right? Which is that, the risk reward here is very favorable over the long term, assuming the Bitcoin continues to behave characteristically. Now, I know we're very far away from the Bitcoin halving, which is targeted to come somewhere around April 2024. So we got a lot of time, and people, may feel comfortable waiting until the halving, and that's certainly a conservative approach and a reasonable approach from a risk management perspective. But I think, uh, you know, kind of opening a major short position here is probably not the best idea and not the type of advice I want to give people. Just because, again, assuming that Bitcoin does eventually follow its characteristic behavior, it's very unlikely that, when price is, somewhere up here after the halving, um, that you'll look back and say, wow, I'm really glad I started building a short position down here after the 77% retracement. That's really unlikely. Really the time to build the shorts was up here. And really, in April was a great opportunity to short right up here. Um, and you had this down to capitulation. In June is when you got your capitulation, right? I don't have the capitulation metrics available, but if you look at realized profit and losses, um, that's when the realized profit and losses started to hit, an extremely, extremely exaggerated, metric. And it doesn't mean that you can't short after that period, but it just means that, you know, once this low was put in, uh, the risk reward for shorts got extremely less favorable. Now, of course, people made money shorting here, here, but really the bulk of the opportunity was right here when the Fed announced they were going to raise interest rates. Basically, October, November of last year. Really, it was early November, so we'll pull this over there. The Fed announced they're going to raise interest rates, and you have this period of time, roughly a half a year between the start of the downtrend and the when the realized losses started to hit extremes. And this is really your window of opportunity for opening short positions, right? Um, Again, just another basis for kind of understanding why uh, it's not the best idea. And you can see here that the capitulation here, again, I don't have the realized losses pulled up, but you can see, if you pull up the RSI, that's really the lowest point uh, that the RSI reached. Well, actually, it actually went a little bit lower on this step here, but basically same level there. And then, although you did have some favorable shorts within this region, that you could have eked out a profit on, eked out more of a profit, really. But after this capitulation, you see divergence building, right? And you get this bullish divergence building. And I know I've talked about this at length, but ultimately you get this bullish weekly divergence running into daily divergence. And then we saw, well, what we're seeing now is we're seeing a break above the prior weekly high. So we'll mark off that level right here. We'll mark off the weekly open and weekly close right here. And again, I want to mark off this low again up there. And then we'll drill down on the lower time frames. Close the RSI right here. Just look solely on price action. So we've got our weekly high right here, our weekly close right here. And you can see that price ran up above the weekly high, ran up, took the stops, tested back down. You get a successful retest off this weekly high right there, and a rally up, and then a rally back down into this level. Again, now, we can really, now the low I want to focus on is this low right here. If we see a run below that low, then the way I would be trading this is looking for a run of further liquidity to the downside. So if this low gets violated, then I'd be looking for this low to get ran and this low to get ran as well. Well, not necessarily both of those to get ran, but I would just broadly be looking for downside liquidity to be ran. If we lose the 16,722, I'd be looking for 1,600 to be ran. And, and we got to go level by level, but potentially, the market would start running for liquidity to the downside before, ultimately shifting around to the upside at whatever point in the future. So from right here, you do have a decent risk reward perspective, at the very least, for a push up to this 17,592 level. Again, if you frame this off as a favorable long position from the current price, let's see right here. That's a 3 RR trade, 3 risk, 3 reward. 3-to-1 risk reward trade. So you got favorable odds there. Now, I do want to draw your attention to the larger structure that's going on here, and I think it's better to see it if we invert the chart. Now, again, here's your daily chart. Uh, we'll just pull everything off. Here's your daily chart. Now let's just invert it very quickly. So you've got this right here, and let's drill down into this, right? So you've got this FTX collapse right here, pushing price really down, but you get this kind of trend line forming here. So we can mark it off right here. So you get this impulsive move up, right? Very, very erratic movement up. But you get a little bit of a price pause right here, and then price, peaks up here, tests off that level, runs up here, and then here again runs up above this level right here. And you can see how you get a test down into the price pause right here, liquidity run above here, break back into the range, and then ultimately breaks this trend line right here. So I want to use this as an example to talk about, the different ways that you can frame a retracement. So we have this retracement here, right? The broader retracement that we're looking at from right here. And the reason why I've inverted the chart is because, a lot of times when people look at the chart, they, if they're in a fearful state of mind, they impose the concept of gravity to price action, right? If they're feeling fear, they imbue price with a sense of gravity, right? But that it doesn't actually have, right? So um, if that does happen, you can do a little psychological trick where you just invert the chart, and then your mind, after a break of structure, and then your mind will imbue uh, the sense of gravity to the break to the upside. And hopefully that makes sense, but just stick with me on this. But essentially, you get this. You've got this frame to frame the greater expansion and volatility. You've got this test down, liquidity run, and then your break of structure right here. Right, the way you can see that is anytime you get a run above the liquidity like this, and then just run above and then slam back down, that's usually a bad sign. That's usually showing you that this is an apex and that price is going to form a greater retracement, right? So your first red flag was the liquidity run and then the slam back down into the range. That's always not a good thing to see if you're looking for a breakout. And then ultimately then you get a break of this trend line, right? And you could, whether you're using the diagonal trend line, it's not a magic line, or you mark off the lows right here, same difference really at the end of the day. Really it's these lows being broken that it actually is significant. The diagonal is just for illustration. You can see now, you see that was the same weekly high we were talking about before. Test off there, bounced off there. So um, so you can see this retracement here, and it gives you a framework to uh, look at this as a potential area of interest, right? So I know I marked off a region here, but ultimately with this break, you do have a potential scenario where you could retrace this retracement, down to a 618 right here, which would line up with the base of this consolidation. Now, it doesn't mean this has to happen. You can, you can get another throw up above the liquidity above here. And you may say, well, I mean, you're saying it can either go one way or the other. Well, yeah, I mean, that's the inherent nature of price action. But I do think the big takeaway here is that with what you're seeing on like the weekly, the daily, the 4 hour, these types of characteristics and price behavior, um, you're starting to see that this area, broadly speaking, is probably going to serve as a bottom in price action. It's kind of the characteristic area that you would expect to see a bottom. Now, what I just did was I just uh, uninverted the chart, and this is just the weekly chart, broadly speaking. So you can see this liquidity run down below here, and then a run above the highs. Uh, sometimes on the higher time frames, you see things shake out a little bit more before they ultimately make a run for the retracement. So you could see another push down. Remember, we talked about that if the 16777 level is ultimately lost. But broadly speaking, I would consider that a buy just with what's going on in the RSI. Now, of course, this lines up with what's going on in the dollar currency index. You can see that just, dollars just breaking and falling down. Now, is there any public news or public reason why this should be happening? Not really. Is it possible that the market knows something that we don't know as anonymous public people? Probably, right? I mean, people, insiders get tipped off on information before we as the public do, right? So it's hard to rely on public information for your source of information because you're always going to be late, right? So, um, but of course, we have access to price action, right? So we can see that that this this parabolic trend has broken right here, right, and it broke a long time ago. So we may not have access to the reason publicly why this happened, and we may find that out later. But we still have the price distinction in the chart that we can trade. So I think that that's important, right? Everybody's looking for a pivot in the market for the Fed to come out and you know release the doves from the cage. But of course, we don't see that until much later, much later. Now, just going to SPY. Oh, I wanted to look at the Dow Jones Industrial Average because I do think this is the most important chart right here. You can see that the Dow Jones has already taken out its prior high up here. So this index is actually leading the broader equity market. Um, I know people talk about SPY or NASDAQ, but this is very significant. You got a weekly close above this level right here. Now, if you've been following my previous videos, I was talking about the potential for the equities markets to reach for these highs. Let's see if we market. So you have your quarterly pivot right here, right? You got your Q4 October 1st, and this one really just ran for the highs above here, liquidity above here. Now we haven't seen that characteristic on SPY, right? So SPY did the same quarterly pivot right here, but hasn't yet reached for these highs up here, and neither has NASDAQ. So if you go over to NASDAQ, you see, NASDAQ is lagging, SPY's right in the middle, and the Dow Jones Industrial Averages can be said to be leading, right? So, I had speculated on SPY that we saw the quarterly change in behavior and that we could expect to see that change of behavior run up above these highs right here and continue until the quarterly close or the yearly close. Well, I think what's another layer to that is that we've already seen that distinction on the Dow Jones Industrial Average. So if this index is leading the rest of them, then we want to pay attention to it, right? So if, does the Dow Jones, what does the Dow Jones do from this point, right? And that's a very important distinction. So, it's ran above liquidity. What does it do from here, right? Does it retrace or does it continue the rally? That's very significant. I think it'll have carryover effects on the rest of the equity market. Now, if it does, if and I don't want to make a decision that it will do one way or the other. I actually think it's more likely that that it grabs this liquidity and retraces. That's actually what I was expecting for the other equity indexes. But there is a non-zero possibility that it keeps running and keeps rallying into the year end. And in that scenario, you could have a situation where theoretically, if the Dow Jones keeps rallying into year end, you could have it closing around all-time highs. And then you could have a scenario where, that has a lot of carryover into the following year when you're, uh, just a long way of saying that we could be very quickly at a scenario where equities are creating new all-time highs and people are wondering, how it happened, and not only how it happened, but how it happened so fast. Anyway, I think I'll leave it there. Again, not a prediction or not even really the most likely scenario, but just a scenario worth discussing. If you guys like this video, make sure to leave a like on the video below, and also subscribe to the channel if you haven't before. And I'll